The Federal Reserve Bank has found itself at the center of attention in recent months, what with everything from money printer memes to the future of capitalism as we know on the line. The Fed has obviously been an incredibly influential entity. But it's also something that most people really don't know much about, or worse, think they know a lot about when they really don't. But that's okay, because the Federal Reserve Bank is a bank, so the best way to get a really good understanding of how it works is to just follow the money and answer a simple question. Is the Reserve Bank profitable? Now, because I hate YouTube videos that needlessly drag out a question to get their average watch time up, the short answer is yes, massively profitable. It's actually the most profitable organization in the world after recently beating out Saudi Aramco. But don't click away just yet. For starters, I need that average watch time too. But more importantly, finding out how money works to generate massive profits at the Federal Reserve Bank will teach you a lot about how this almost mythical institution actually operates day to day. So, the core responsibility of the Reserve Bank is not to generate profits for its shareholders like it is any other bank out there, or any other company for that matter. Instead, the Reserve Bank has two primary goals.
My duty is one that Congress has given us, which is to use our tools to achieve maximum employment and stable prices.
The first and most important goal is to maintain the value of the currency that they represent, or put another way, control inflation. The second goal is to maintain a healthy level of economic growth and employment, but curiously enough, this cannot come at the expense of the first goal. A year where the US economy grew by 50%, but prices also rose by 50%, would be seen as a failure in the eyes of the Reserve Bank, although this is of course a very extreme example. However, this does not mean that the US Federal Reserve does not have shareholders. In fact, it doesn't even mean that it is one single entity. The US Federal Reserve Bank is actually an organization of 12 banks spread across the US. It was set up like this because, back in 1913, banking was done primarily with paper notes and paper records. So, having a central bank geographically close to those different regions was crucial in allowing them to swiftly carry out their operations when required. It was also politically popular to have a series of central banks that would each individually be compassionate to the needs and requirements of their own individual region of the economy. Now, as for the shareholders, who are they? Well, they were the regular old banks. If you want to start a bank in the United States to loan money and take deposits, you actually need to be a shareholder in the Federal Reserve Bank. Individual banks need to maintain a share ownership equal to 6% of the total amount of money that they raise from shareholders. This might sound like a weird rule, but there is a reason it is done. There are basically three ways that banks can raise money. They can take deposits, they can borrow, or they can sell shares. Those first two options come directly under the control of the Federal Reserve through interest rate changes, but selling shares is not directly impacted by these rates because shares are not an interest-bearing asset. You don't get 5% interest paid out on Apple shares. You get market returns, whatever they may be. Positive, negative,
sideways, or in f***ing circles.
By mandating ownership of shares equal to a portion of a bank's paid-in contributions, the Reserve Bank knows that the participating institutions will always have skin in the interest game. What's weird about these shares, though, is that they always pay out 6% of their value every year, which is interesting for two reasons. The first is that this is a fantastic guaranteed rate of return, especially in a world where similar guaranteed investments are paying less than 1%. Many have lamented that this is basically a subsidy paid by the American taxpayer and paid to big banks, which is not entirely unfair. The second reason this is interesting is because this will be paid out whether or not the Fed makes a profit or not, which is not how normal dividends work. So, in a way, these shares in the Federal Reserve Bank kind of blur the line between a typical company stock and fixed interest bonds. Either way, this still doesn't explain how the Federal Reserve Bank turns a profit. Unfortunately, it's not as simple as what the money printer memes might have you believe. You see, the Federal Reserve Bank doesn't just create money to use on whatever they please. They instead carefully purchase select assets like government bonds and mortgage-backed securities with the money they create. They are also somewhat limited with who they can purchase off with this newly created cash. For example, the Treasury Department of the United States issued trillions of dollars worth of government bonds in order to finance the stimulus spending in 2020. Unfortunately, the Fed could not buy these bonds directly. Instead, these get purchased by private parties. This could be anybody from mere mortals like you or I, but more often than not, it is large financial institutions like banks. Banks love government bonds because they can use them as part of their reserve requirements while still earning interest on them. Not much interest, mind you, but it's better than the 0% they would get holding onto pure cash reserves. Now, if there is ever a situation where either the banks or the government needs a lot of cash, the Reserve Bank is ready to step in. In 2020, the Fed purchased trillions of dollars worth of these bonds from banks, so that those banks could in turn go out and purchase more bonds from the Treasury without the price of those bonds being too heavily impacted. Now, as we have noted, the return on those bonds were not huge, most of them still being under 1%. But 1% of trillions of dollars is still a lot of money, especially when these bonds are being paid for with money that was created for free. Assuming a simple 1% return on investment, the $4.8 trillion worth of US Treasuries currently held by the Fed would return $48 billion in profit per year. When you consider that the Fed also owns $3 trillion worth of private sector securities like mortgage bonds, this annual profit figure balloons to well over $80 billion annually, based off even the most conservative projections. What's more is that this isn't even the end of the story. Everything that we've looked at so far is known as open market operations, meaning the Fed is buying assets off the open market. Go figure. But there is an additional revenue source that doesn't attract nearly as much attention. That is, well, closed market operations. You see, the Federal Reserve Bank is a bank for banks. They offer deposit facilities, loans, transfer capabilities, and even cash distributions. Now, just like every other bank ever, the Fed charges fees for all of these services, and you can actually find a breakdown of these charges on their website. Not that they would ever really matter to you individually. Even still, this is not a small operation, and these services bring in billions of dollars every year. Collectively, the Reserve Bank brought in a net profit of over $90 billion in 2020 from open and closed market activities, which technically makes it the most profitable organization in the world by some margin. So you might ask, how is this fair? The Reserve Bank gets to create money from nothing to buy up debts and then makes massive profits on those debt returns. Why are they allowed to do this? And even further from that, if they create all this money into existence and then demand interest on the money they create, won't we all eventually be in debt to the Fed? Well, not really. Tinfoil hats aside, the Fed first uses this money to cover its operating expenses, things like security, staff wages, and maintenance on its buildings. It will then cover its financial expenses, like the interest paid out to banks that have deposits with the Fed, as well as the 6% dividend that gets paid every year. After that, whatever is left over will simply be given to the Treasury Department. In 2020, for instance, the Fed sent back over $88 billion. This effectively makes the Fed more of a control mechanism in the circular cash flow between households, the government, and financial institutions, which is not quite as exciting as stories of world domination, but it is effectively all that they are. Now, if you are hoping for high finance with a bit more excitement, then you should go check out our video on how EVE Online's massive virtual wars are financed using the most realistic video game economy in the world. Thanks for learning how money works.